As investors, we like to think experience breeds perfection. However, even seasoned professionals are human, prone to cognitive biases distorting perspectives. By understanding common traps, we can avoid losses through discipline. Here are the top 3 mistakes pros regularly make. Overconfidence in forecasts. Relying solely on predictions, lacking stimulus response analysis. When rates rose unexpectedly in 2022, many held losing bonds too long versus hedging or pivoting allocations earlier. Narrow framework. Focusing solely on momentum or value rather than rotating between factors deliberately. A balanced process outperforms rigid styles over cycles by capitalizing on macro rotations. Scale blindness. Successfully piloting smaller strategies, but struggling to prudently manage risk at larger asset pools. Oversized positions inevitably lead to unnecessary drawdowns that damage long-term returns. The solution? Leverage an impartial yet superhumanly powerful assistant like ChatGPT synthesizing alternative perspectives. It helps sensitivity test assumptions and adjust quantitatively before biases materialize as costly mistakes. Understand even experts aren't immune. AI keeps you learning to consistently beat markets through any phase. As mentioned, even seasoned professionals fall prey to cognitive biases at times that distort perspectives. By delving deeper into each mistake, we can better understand how to avoid them. Overconfidence in forecasts. Relying solely on predictions without stimulus response analysis leaves one exposed when unexpected events occur. In 2022, rates rising faster than projected caused many bondholders losses by delaying pivots. ChatGPT reduces this risk through its superior data processing and alternative modeling capabilities. Requesting macroeconomic analyses, it may highlight rate sensitivity variances between countries based on debt levels. This informed timely bond reallocations, preserving capital as others underperformed. Its machine learning also helps gauge real economic impacts versus simplistic projections. As inflation persisted contrary to forecasts, discussing transmission mechanisms with ChatGPT reinforced prudent hedging and rotation into commodities, benefiting portfolios immensely. Strictly momentum or value biases fail considering larger macro rotations over long market cycles. A balanced multi-factor approach optimized for all economic conditions outperforms rigid styles. ChatGPT advises dynamically calibrating factor exposures based on changing backdrops. Recently, it identified weakness in quality stocks as rates rose, validating a recommendation to temporarily pair overweight positions preserved during downturns. Its vast data analysis also detects subtle rotation opportunities before obvious signs emerge. Last year, inquiring about industrial production, it exhibited cement sales accelerating in emerging Asia before broad consensus formed, enriching strategies targeting construction. While smaller allocations may prove concepts, prudently scaling risk amid larger pools proves far more difficult for humans alone. ChatGPT reduces this by quantitatively stress testing different position sizing. Requesting portfolio simulations, it models optimal hedge fund position weights, accounting for slippage and trading costs, guarding against complacency as assets balloon. Insights sharpen operational excellence essential for long-term wealth preservation. Its AI optimization further adjusts exposures automatically according to pre-programmed risk parameters. This co-piloting affords pursuing greater profits yet calms anxiety over blow-ups many experienced lately holding uninsured concentrated stocks. In conclusion, even the most seasoned professionals benefit eliminating mental vulnerabilities through diligent processes combining human intuition with AI judiciousness. Our edge lies not in opinions, but wisdom crowds collectively advancing us.